When you sit down to watch a really skilled stage magician, there's always that one specific moment where they wave, like a brightly colored handkerchief in the air.
Right, the classic misdirection.
Exactly. Your eyes naturally track the movement, right?
Right.
The bright red silk, the sudden flourishes. And because your brain is just so intensely focused on that incredibly obvious flashy distraction, you completely miss their other hand.
Yeah, the hand quietly slipping the watch right off your wrist.
Yes. You leave the theater thinking you just witnessed magic, but really, you just fell for perfectly engineered misdirection.
It's the illusion of focus. We are biologically wired to pay attention to the loudest, most visible stimulus in our environment. Our brains want to conserve energy, so we lock onto the movement. We think we're seeing the whole picture, but we're actually only seeing exactly what the magician designed for us to see.
And when you step into the world of cryptocurrency trading, that brightly colored handkerchief is waving in your face 24 hours a day, 7 days a week.
Oh, absolutely. It never stops.
It's the breaking news alerts, the sudden price spikes, the panic selling, the social media hype. It is completely blinding. But today, we are going to look away from the distraction. Welcome to Bitcoin Deep Dives by MyCryptoParadise.
Thrilled to be here.
This isn't your ordinary run-of-the-mill market update. Today, we are opening the vault doors and giving you an exclusive look inside the sanctuary of a professional crypto hedge fund.
That is the exact goal today. We aren't here to, chase the shiny objects or panic over the latest headline. We are here to look at the invisible mechanics behind the trick. We want to show you the market exactly as the professionals see it.
And our mission for this deep dive is to completely decode an internal analysis by Simon, who is one of the elite traders from the Paradise team. And we're going way beyond just looking at lines on a chart today.
They're deeper, yeah.
We are diving into the raw psychology of the market, the behavioral biases that routinely wipe out retail traders, and the exact razor-sharp difference between a professional trading mindset and a gambler's mentality.
Because by the end of this deep dive, you are going to understand how to view the market through the cold, calculated lens of a Paradise team professional.
Exactly. You'll see how to protect your capital, build genuine trust in your own strategy, and shield yourself from the deafening noise of the masses.
But, to understand how those professionals actually trade, we have to start with the opposite end of the spectrum.
Right.
We have to analyze why the masses, the everyday retail traders, consistently lose their capital over the long run. And it almost always comes down to how human beings process narrative and news.
Okay, let's unpack this. Because if we look at the recent action in the market surrounding global news, it's wild. In the internal analysis from Simon, he highlights the recent reopening of the Strait of Hormuz.
Yes, a massive geopolitical event.
Right. For context, this is a major global shipping and geopolitical choke point. The analysis noted that there were severe geopolitical tensions involving Trump and Iran surrounding this specific event. And before we go a single second further, let's be absolutely clear. We are taking zero political sides here.
None whatsoever.
We are not endorsing any viewpoints. We aren't picking a team left or right. We are purely analyzing how this political news event was digested by the financial markets.
And that is a vital distinction. The market itself doesn't have a political affiliation or like a moral compass. It only has reactions.
Right.
It processes data and converts it into buying and selling pressure. And the reaction to this specific news was incredibly telling about retail psychology.
It really was. So the news drops that the strait is open, tensions supposedly cool down, retail traders, what the institutional world sometimes brutally refers to as dumb money, they saw this positive news and got incredibly bullish.
Oh, they went crazy.
They thought, great, crisis averted, everything is fine, the macroeconomic landscape is saved, the market is going to the moon, and they started aggressively hitting the buy button. Heavily relying on leverage, too.
Yeah, to maximize their bets. And the live fear and greed index simultaneously shot up to a massive 80, which is the zone of extreme greed. An index at 80 means the market is practically vibrating with FOMO, the fear of missing out. People aren't buying based on structure. They are buying because they are terrified their neighbor is going to get rich while they are left behind.
But I'm going to push back here for a second.
Right.
Because if I'm looking at this logically, if genuinely good global news drops and a crisis is averted, isn't it perfectly rational to buy?
You would think so, right?
Right. If the fundamentals of global shipping improve, shouldn't the asset prices reflect that? Why is acting on positive data considered dumb money?
What's fascinating here is the total misunderstanding of cause and effect in highly speculative markets.
Yeah.
The retail trader believes that the news is the engine driving the car. They think the headline physically pushes the price up, but professional traders know that the market is going to move up or down anyway based on deep underlying technical structures, liquidity voids, and macroeconomic cycles. The news isn't the engine. The news is merely a catalyst.
A cat.
Right. It's a story that the market uses to accelerate a move that was already being engineered behind the scenes.
Okay, so it's like thinking the stadium announcer is the one playing the actual game.
Exactly.
The announcer is just giving you a narrative for what the athletes on the field were going to do anyway.
Yes, but let's take that announcer analogy a step further. The announcer makes it exciting, right?
Sure.
The announcer hypes up the crowd, gets everyone out of their seats, makes them roar, but the announcer has zero impact on the actual physics of the game. When the retail crowd hears that announcer, the breaking news, they react with intense emotion.
Right.
But while they are reacting to the story, the professionals are reacting to the underlying structure.
So if the announcer's just hyping the crowd, we really have to ask who is actually benefiting from that hype. Because while retail was aggressively buying this news, convinced a massive rally was starting, the smart money, the whales managing hundreds of millions of dollars, they were quietly doing the exact opposite.
Oh, they were just waiting for them.
Waiting for them. The data in Simon's analysis is staggering here. These whales set up anywhere from $257 million to $366 million in what are called iceberg cell walls.
Right, at that massive pre-planned resistance level of $78,000.
$78,000. Now, if a whale with $300 million just hits sell on an exchange, they nuke their own price.
Oh, instantly. They'd crash the market before half their order even filled.
So they actually need retail FOMO just to create enough buyers to absorb their bags.
Precisely. If you are managing institutional level capital, you have a very specific problem that everyday traders don't have. You lack liquidity. You need an enormous pool of eager buyers to offload your positions onto without causing massive slippage.
So they use an iceberg order.
Exactly. Just like a real iceberg, you only see a tiny fraction of it above the surface. The exchange order book might only show, say, 10 Bitcoin for sale.
And retail sees that, thinks, oh, weak resistance, let's push through.
Right, and they buy it. But the whale's algorithm instantly replenishes that 10 Bitcoin over and over and over again.
Man, it is a perfectly executed liquidity trap. They flash a little bit of supply, maybe pull it back momentarily to make the market think the resistance is broken.
Which encourages retail to keep buying on leverage.
Exactly. But that massive $366 million wall of supply is sitting right there in the dark, completely stable, absorbing every single buy order the greedy crowd throws at it. They are essentially weaponizing human psychology to solve their own liquidity crisis.
They absolutely are. And the internal analysis uses this brilliant analogy to explain what is happening on the charts during this exact trap. Simon calls it the car analogy.
Yes, I really want to break this down because it clarifies so much. Yeah. Simon says to imagine you are driving a car up a really steep hill. That hill is the price going up on the chart. You look out the window and you're getting higher and higher.
And the retail trader just looks out the window and thinks, up is good, we're going higher.
Right, but the professional trader isn't looking out the window. They're looking down at the dashboard. And on a trading chart, that dashboard is your momentum indicators, specifically the OCD and the RSI. So while the car is still creeping forward up the hill, you look at the fuel gauge, the RSI, and you see it rapidly dropping toward empty.
The car is moving forward on sheer inertia, but the engine is dying.
And we should explain mechanically how that dashboard actually works, because it's not magic.
No, not at all. The RSI, or Relative Strength Index, measures the speed and magnitude of recent price changes. The MyCryptoParadise looks at the relationship between short-term and long-term moving averages.
Right.
When the price of Bitcoin makes a higher high, meaning the car went further up the hill, but the MyCryptoParadise makes a lower high, the mathematical momentum is shrinking. The actual buying volume is evaporating.
And eventually, when a car runs out of fuel on a steep hill, gravity always wins.
Every time.
That is what technical analysts call a bearish divergence. The price action is completely disconnected from the underlying market strength.
The price is drifting up purely on the fumes of retail FOMO, but the actual heavy buying power from the institutions has completely stopped.
They're no longer pushing the car.
Nope. They are sitting at the top of the hill, setting up their iceberg orders, waiting for the retail traders to push the car right into their trap.
So if these whales are mathematically engineering traps, based on our predictable human emotions.
Right.
How do you actually stop being the prey? Because seeing how easily the retail crowd is manipulated really brings us to the core philosophy of MyCryptoParadise.
It highlights the massive psychological divide between gambling and professional trading.
Yeah, the retail trader buying that news, they aren't trading, they're literally gambling.
They're pulling the lever on a slot machine and hoping the screen flashes green. They get a dopamine hit from the action itself.
And the dangerous part is, gamblers can actually push buy or sell and get lucky for a few weeks.
Oh, sure. They might even ride a bull market for a few months and think they're absolute geniuses.
Right. But because they have zero underlying risk management, the mathematical probabilities will inevitably, relentlessly crush their portfolios in the long run. Here's where it gets really interesting. How does a trader actually cross that psychological bridge?
It's tough.
How do you rewire your brain to go from being a lucky gambler playing with the crowd to a disciplined Paradise team professional operating behind the scenes?
It requires a complete destruction of how you currently perceive success and failure. Simon's methodology breaks this down beautifully. A gambler is entirely fixated on the outcome of a single trade.
Win or lose, right there.
Right. If they win, their ego swells, they think they're a market wizard. If they lose, well, the market is rigged, the exchange cheated them, or the news lied.
It's always someone else's fault.
Exactly. But a professional doesn't look at a single trade at all. They look at statistical patterns. They ask themselves one defining question before they ever risk a dollar. If I take this exact specific trade setup 30 times in a row, will I be net profitable?
So it's all about the sample size. If I flip a coin once, it might be heads. But I can't build a business on that one flip.
Precisely. You have to accept that out of those 30 trades, you might lose 12 of them. That's a given. A professional doesn't care about the 12 losses because they know the 18 wins managed with strict risk-to-reward ratios.
Say, risking $1 to make 3.
Right. That will make them highly profitable overall. You could have a win rate of just 40%, and if your risk-to-reward ratio is dialed in, you will consistently grow your capital.
Right.
But to know your probabilities, you have to stress test your strategy. In the Paradise team, they stress test every tactic over a full 3-year market cycle.
Why 3 years specifically? I mean, why not backtest over the last 6 months to see what's working right now?
Because a 3-year cycle in crypto encompasses every conceivable type of macroeconomic weather. It includes the euphoric post-halving bull markets, the crushing liquidity drain bear markets, the sideways chop that bleeds out impatient traders.
Periods of quantitative easing, high interest rates.
Exactly. All of it. If your strategy only makes money when the entire market is universally going up, you don't have a strategy. You just have a coincidence. Stress testing over 3 years proves whether a tactic has a true mathematical edge against market noise, or if you just got lucky surfing a temporary wave.
So if the mindset is just accepting probabilities and trusting your edge, the actual battle isn't fighting the market. It is fighting your own charts. Let us look at how Simon physically executes this on the screen to hide his capital from those whale algorithms.
Yeah, let's get into the tactics.
Because once you have that professional mindset, the absolute non-negotiable priority becomes the protection of your capital.
It is the golden rule of hedge funds. If you lose your capital, you lose your inventory. You lose your ability to play the game.
Right.
A professional would far rather completely miss a market bottom, just sit on their hands and watch a massive rally sail by, than risk their capital unnecessarily on an unconfirmed high-risk setup.
Which goes against every human instinct we have. We are desperate to catch the exact bottom because our ego wants the maximum possible profit.
Oh, absolutely.
But Simon points out in his analysis that the current market structure simply isn't ready for that. He describes the market as an organism forming a breathing pattern. You have your inhales, which are the motive waves pushing the macro trend forward.
And your exhales, which are the corrective waves pulling back and consolidating.
Exactly. Right now, according to the data, the market is in an exhale, a corrective mode.
And recognizing that we are in an exhale dictates everything a professional does next. It means the path of least resistance is currently pointing toward potential downside targets.
Yeah, Simon's analysis explicitly marks out significant structural supports, waiting at $54,000, then $49,000, and finally a deeply structural magical bottom target around $44,000.
Down at $44,000.
Right. Meanwhile, the major upside resistance targets are sitting way up at $84,000 and eventually $169,000. But until the underlying structure confirms a definitive change in direction, professionals remain incredibly defensive.
They don't try to guess when the exhale is over. They wait for the market to prove it.
Which leads me to one of my absolute favorite tactical secrets in this entire deep dive, the psychology of stop-loss placement.
Oh, this is so good. This is where behavioral science meets the raw order book directly.
Yes. Okay, if you are a retail trader setting a stop-loss to protect your trade, you almost always use a round number. For example, if you want to protect your long position around the 73,000 mark, you naturally put your stop at exactly 73,100 or maybe 73,000 flat.
Right.
Why? Because human brains are lazy. We naturally gravitate toward round, even numbers. We like the psychological comfort and symmetry of 73,000.
And the smart money algorithms are explicitly programmed to hunt for that exact psychological comfort. Because the whales know that thousands of retail traders place their stops at those round numbers, they will intentionally drive the price down to those exact levels.
Just to trigger them.
Why else? To trigger all those stop losses at once. When a long stop loss triggers, it automatically becomes a market sell order. It creates a cascading avalanche of forced selling, which the whales then happily buy up at a massive discount.
It's an engineered liquidity grab. So how does Simon counter this? He never uses round numbers. Instead of 73,100, he places the stop at something irregular, like 72,900.
You are tucking your capital just safely out of reach, hiding in the shadows while the whale's searchlight sweeps right past you.
Exactly. And to hide even better, Simon's analysis relies heavily on structural confluences.
Confluences are key here. He uses tools like the VPVR, or Volume Profile Visible Range.
Let's explain how the VPVR works, because it is a complete game changer compared to normal volume. Normal volume bars are at the bottom of your screen showing you how much was traded during a specific time, like a 4-hour candle.
Right, time-based.
But the VPVR sits on the side of your screen. It shows you how much volume was traded at specific price levels, regardless of when it happened.
Exactly. The VPVR shows you the point of control. It literally maps out where thousands of traders are stuck breaking even. If a massive amount of volume happened at 73,200, it creates a psychological brick wall.
And Simon uses that data.
He does. He hides his stop loss physically behind that wall of historical volume, or behind a 4-hour moving average trend line. You are using the market's own structural architecture, the literal bricks and mortar of past trades, to shield your capital from the noise.
If we connect this to the bigger picture, this obsessive level of detailed risk management is the foundation of how MyCryptoParadise operates.
Without a doubt.
It functions precisely like a high-tier hedge fund. You have a team of elite traders, and what's fascinating is they don't all trade exactly the same way. The analysis mentioned another trader in the team, known as the wolf trader.
Yes, the wolf trader recently took a long position on Ethereum, anticipating an upward move, while Simon's personal tactics were telling him to remain in cash and wait.
Now, to a beginner, that sounds like the team is disorganized. Why are two elite traders doing opposite things?
Because different professionals excel in different microcycles, relying on different verified edges. The wolf trader saw a very specific reaccumulation pattern forming in Ethereum.
Okay, for those unfamiliar, a reaccumulation pattern happens in the middle of a larger macro uptrend. The price stops going up and starts chopping sideways.
And to the retail eye, it looks like a market top and people panic sell. But the wolf trader recognized the internal volume signatures. Smart money wasn't dumping. They were just pausing to absorb the new retail supply before initiating the next leg up.
So that specific pattern fit his deeply back-tested tactical edge.
Right. Simon's edge simply relies on different structural confirmations.
But the crucial part is, even though they are taking different setups, they are both operating under the exact same impenetrable umbrella of strict risk management. They are sizing their positions so that one loss doesn't dent the portfolio.
Yes, and they are both only taking trades that they would be mathematically comfortable taking 30 times in a row.
So what does this all mean? For you, the listener, how do you actually integrate this into your own trading tomorrow?
Well, it means that building long-term trust in a system requires a complete paradigm shift in how you process failure. You have to start viewing your losses not as personal indictments, not as proof that you are fundamentally bad at this, but simply as essential data points.
Yeah, losses are just feedback.
They are the calculated overhead cost of running a professional trading business.
A loss is literally just the market telling you that a specific 60% probability didn't play out on this exact spin of the wheel. That is all it is. It shouldn't trigger anger, it shouldn't trigger aggressive revenge trading with higher leverage, and it shouldn't cause despair.
It's just a data point to be logged in the journal.
Which brings us full circle to the core journey of this entire deep dive. We started by looking at the brightly colored handkerchief, The flashy global news of the Strait of Hormuz, the retail masses rushing in blindly with maximum leverage, their fear and greed dials completely pegged at 80.
The dumb money reacting to the stadium announcer, thinking their emotion was going to move the market.
Exactly. And over the last few minutes, we have moved away from that trap entirely. We've stepped behind the curtain to see the $366 million iceberg sell walls waiting to harvest that exact greed.
We've seen how the Paradise team completely ignores the noise of the news cycle, focusing instead on the dashboard, checking the MCD and RSI to see if the car is quietly running out of fuel on the hill.
We have adopted the cold, disciplined mathematical probabilities of a true professional. And to really solidify that professional mindset, the internal analysis ends with Simon's ultimate mantra.
It is a philosophy that every single successful trader eventually adopts if they want to survive in this industry.
Right. He states, I operate purely on probabilities, not emotions. I remain calm and disciplined in every single market condition. I respect risk management and protect my capital above all else. And most importantly, I completely detach from the outcome of any single trade.
I completely detach from the outcome. That is such a powerful psychological state to achieve. It completely removes the ego from the equation. You aren't trying to prove you are smarter than the market. You are just executing your mathematical edge.
It really does remove the ego.
Yeah.
And as we wrap up our time inside the sanctuary of MyCryptoParadise today, I want to leave you with a final thought to mull over.
Okay.
We started this deep dive talking about the magician and how predictably easy it is to be distracted by the shiny object while your watch is stolen. Well, now you know the trick.
You know the mechanics.
You know the whales are out there, quietly building their massive, invisible cell walls, patiently waiting for a news story to make the crowd feel an overwhelming sense of extreme greed.
So the real question you have to ask yourself tomorrow morning, when you open the charts and you see the latest breaking news screaming at you to buy, and your own FOMO starts to spike.
How do you train your own brain to feel an overwhelming sense of caution, precisely when the rest of the world is telling you that a sure thing is about to happen?
Because that is the exact moment you discover the difference between playing the game and just watching the magic trick.
Thank you for joining us for this exclusive look inside the internal analysis of the Paradise team. We hope this deep dive helps you apply that cold, professional edge to your own journey and helps you trust your own system. Stay disciplined, protect your capital, and we will see you next time on Bitcoin Deep Dives by MyCryptoParadise.